Hi guys, welcome to this new session of CFA Level 2 Equity. Today we'll be covering the remaining portion of our reading free cash flow valuation. So in the first session, we covered the details as to how exactly do we calculate free cash flows from the company's financials, from all the information that would be provided to us. So we looked at various equations, we looked at various alternatives, we looked in detail as to what the different components are of free cash flows. And we also looked at the idea that for valuation of equity, you should use free cash flow to equity with cost of equity, and for the entire company valuation you should focus on free cash flow to firm with weighted average cost of capital. Today we'll be focusing on this valuation part. So first session was focused on free cash flow part. This time we'll focus primarily on valuation part, and the good thing is this session is going to be very basic, probably also relatively short, because what you have in valuation part of this reading is an exact copy paste of what you covered in the discounted dividend valuation topic. So let's get into the first section that we have, which is focused on single stage models. Now, if you remember, in dividend we used to have Gordon growth model. This is exactly same. So in the dividend, the equation was something like this. P0 was D1 KE minus G. We'll use the exact same thing here. V0, so I'll say value, free cash flow. Now I'll write all the equations in the form of free cash flow to form, but just keep in mind, you can replace this value with free cash flow to equity. The only thing you have to change is, instead of this weighted average cost of capital, instead of this, if you're replacing free cash flow to firm with free cash flow to equity, instead of cost of capital, use cost of equity. That's it. This has to be for year one, so always 1 year ahead. This can also be calculated as free cash flow to firm 1 plus growth. So let's look at a basic example to further clarify the concept. So a firm has free cash flow to firm of $5 million, expected to grow at 3% per annum if the weighted average cost of capital is 12%. Now it has, which means it's current, so it is 0. So the calculation is fairly straightforward. Value would just be free cash flow to firm, which is 5, 1 plus growth rate, because this is what we have given as 5. 1 plus 0.03 upon 0.12 minus 0.03. When you solve for this, you get a value of $57.22 million. Now keep in mind, there is one very basic difference between how we have free cash flow valuation and how we had dividend based valuation. In dividends, we were using dividend per share in the numerator. So that value was already per share. So the price we were getting was also per share. But over here, this free cash flow is not a per share value. This is free cash flow as a whole. So if the free cash flow is as a whole, the value is also coming out for the firm as a whole. If you do it for equity, it would come out as value of equity as a whole. If the question is asking you for per share price, make sure you divide this value with the number of shares to get the price per share. So please keep that very clear in mind, that if your cash flows are for the entire firm, for the entire equity of the firm, you will get price for the entire bunch. If you need per share value, you have to still divide it by number of shares. So just keep that in mind. So I hope the basic part is clear. Let's move to a two-stage model.